Hi, I'm Phil Grande. Welcome to my 7th edition of my Phil's Gang YouTube channel, Getting Closer to the Crash. Okay, this week was pretty interesting. We've gotten some evidence that is really disturbing that is telling us we're getting closer to the crash. Let's start. First of all, what we saw this week, we saw that the 10-year Treasury yield was going up. Right there. See that 10-year Treasury yield? Now, they're going to lie to you, the fake business news network, and they're going to tell you it's going up because the economy's getting better, which is a bold-faced lie. Now, that would be true if CEOs were plowing in capital into business investment, but they're not. They're doing it into stock buybacks. So the Treasury yield going up is very, very negative, very, very negative for the market. It means inflation, okay? That's very, very bad for the market. Some more evidence, the VIX index, right here, the VIX index. Now, the VIX index, when the VIX is high, we buy stocks, but when the VIX is low, we sell our stocks, get out. Do you notice the VIX index is under 20? I've been in this business for 50 years. I don't think I've seen the VIX index under 20 more than twice, and usually right before a crash. This is very disturbing. We're under 20. So being under 20, the fact that we also have the 10-year Treasury yield going up, we have the PE ratio out of whack. Those three items there alone are very disturbing, good evidence, and we got to pay attention to that. But I also got something else that's very disturbing. What most people don't realize, when the stock market crashed in 2008 because of Lehman Brothers, the Federal Reserve immediately, they wanted to move the stock market up. And if you remember, when the stock market crashed down here in 2008, they had to move the market up. So what did they do? Well, they turned around and made a deal, the Federal Reserve, with the pension funds and the insurance companies, and said, let's do this. Let's push the market up artificially. We're going to print money, but what I want you to do is sell me your bonds, sell me your treasuries. So the pension funds, the insurance companies sold the treasuries to the Federal Reserve. The Federal Reserve gave them cash, and then they went in and they bought stock. That's how they pushed the stock market up. They were the big participants. Now, we also had the same thing going on with corporations, the same thing going on with banks, but most of it was pension and insurance companies. But guess what we found out this week? About half of what they've been buying, or half of the bonds they've been selling, they have now stopped. So that means there's been a big reduction in the amount of bonds they've been selling to the Federal Reserve, both the pensions and insurance. That's very, very bad news. So, because remember, that's what has been pushing the stock market up artificially since 2008. Combine that with the fact that we have the PE ratio near 40, we have the VIX index under 15, this is a lot of evidence that this market is getting closer. Now, I'm going to show you one last thing here. Now, what we've been telling our gang members is to start staying with stocks that are making new yearly highs. See right here, these new yearly highs. That's what we're looking for, to start making new yearly highs. And because it's very important, all right, that's pretty much what we're staying with right now, new yearly highs. The stocks that we're staying away from is what we call the 50 percenters. What are those? Those are stocks that sold off like this. There's the high right here. Here's the low, and they're up halfway. Very difficult to get back up into this area here. So you're better off staying with stocks that what we call power stocks making new highs. I'll go more into that next week. Please make sure you hit subscribe, hit like, and please share. Okay, and I'm going to tell you that we're getting very close now, very close. But remember, I can't give you the exact day, but I also can tell you this. We're getting closer, but remember, they've been extending this because of the stimulus. Please remember about the stimulus. Don't listen to all the CNBC and the rest of them. Stimulus does nothing for the economy. Stimulus is crap. It does nothing. It hurts the economy. It doesn't help the economy. We'll talk more about that next week. See you on the charts. Please hit subscribe and like and share.